Hi everybody, Steve Griffiths here, developer of the MTPredictor software program. In today's MTPredictor video, I'd like to have a look at a Forex chart. In this particular example is the British pound against the US dollar, to yet again show how we use our multi-time frame analysis in MTPredictor. The idea being is we use the higher time frame chart to gauge the large degree support and resistance areas. We then go down to a shorter time frame chart to get the trades in the direction from the larger degree sort of trend. So I just want to follow up on the British pound, and you see here the British pound has been rallying up recently, and what I'll do is I'll just use training mode to go back to around here somewhere, and you can see actually that the low came in here. If I go back to this prior pivot here, place the DP on, drag that across, can you see how that caught the low absolutely perfectly? So the large degree trend was up and the market was moving up. This is a 60-minute chart, by the way, an hourly chart. So what do? Well, we look for the next resistance area. So for this we simply go back to the prior pivot high in this one here, right mouse click, place the DP on the chart. Now can you see how that's on the chart in advance? In other words, this is giving you an area of potential resistance on the hourly chart before the market even gets there. That's important because it prepares you in advance for areas where there's likely to be support and resistance. I'll just turn training mode off and you can see what the pound did. It went up there to within literally a pip or so of that area. Now to me that's good enough to justify a reversal. So how do we then look for trades? Well, that's where the hourly chart hit the DP, or just about hit the DP resistance. So let's go down to our shorter time frame chart. So say let's go down to our 15-minute chart. We now want to look for trades that are coming in the direction of that. Can you see there's our 15-minute resistance? It wasn't quite there, but it was pretty close. It was in a pip or so. So I think that's close enough. So in other words, the large degree trend is now down. So we're wanting to look for shorter term sell setups. Remember, we have our history triangles on our chart to show trades that were filled and the market went beyond the bar highs or lows. But remember, sometimes these are slightly different because we only use one tick or one pip beyond the bar highs and lows to place these on the chart. But with Forex we want to give it a bit more wiggle room, so we use 2 and 3 pips for our entry and offset. So let's again use the training mode. Let's jump back to around here somewhere and see what happens. Zoom in a bit. So we're looking for sell setups. So we go forward, we go forward, we go forward, we go forward. Then suddenly we had a TS1 sell setup comes in. Remember, we don't use our STF color because we're using our trend on our higher time frame chart. So on the hourly chart, remember we have hourly resistance, or pretty much so, therefore the large trend is down. Let's right mouse click, place the analysis on, and can you see how our offset here for our entry is 2 ticks, or sorry, pips, and the sell setup, if we're filled, would be 3 pips on the other side as well. Remember, we use correct position sizing, in this case less than 2% on a sample $20,000 account. That means we would be going short 39 mini lots. You can define in our tools and our accounts and risk, you can define whether you're trading mini lots, standard, or you can even put none here if you want to, and it gives you the actual dollar value in this case to actually trade as well. But we're looking at minis in this particular example. We're also plotting it in 10th pips, you can see. So we'll just close that. So that means you'll be looking to sell 39 mini lots. We do have our risk reward here at our first target at only 1.2R, but remember, because we're using a larger offset for Forex, you really want to look for a larger target. Now this is an interesting setup because if this was a major high, this would be the initial decline down, this would be the initial correction. We'd then deem this what we call a holy grail trade setup as a potential wave 2. Therefore the target in this particular case would be going towards the typical wave 3. So here we now drag this down to our typical wave 3 WPT, and you can see how suddenly the risk reward gets greater than 2, so it becomes a trade setup that we'd want to consider. So let's move forward. Here the market's gone just slightly above the high there. Does that mean that we want to avoid the setup? Maybe not, because this looks like a quite good setup. Our short entry level is still there. Go forward, and suddenly can you see how now it takes you in and enters a new short trade. But the important point is, even though we were sort of one tick or one pip or just a pip above the high there, that high was 144.32 and that high was 144. Let's get that right. High was 144.34.7 and that was 144.35. So if you're looking at just pips, they were double top. If you're looking at tenths, it was a 3/10 above. So very, very minor. But the point being is it hadn't gone beyond the stop trigger. So it hadn't hit the stop trigger before entering the short trade. So you're now short. Let's turn training mode off and see what happened. You can see the markets declined sharply. It was going down quite nicely. Remember, we're not using our STF color because the large trend is down. We're not looking for any buy setups like this one here, so we want to hold short. We're looking to come into at least the typical wave 3 WPT. When the market reached that level, which it did here, the STF was strong. It was beyond our grey band, which was pretty much zero, so therefore we have permission to trail with our ATR stop, which is our red dots there. So that means the market would have been stopped out just about here, or the short trade would be stopped out just about here for a profit of 5.6R. In other words, turning an initial risk of just under $400 into a profit of just, well, almost 2,200, 2196, ignoring slippage. But the point being is, do you see how we first and foremost gauged our DPs on our higher time frame chart? That then gave us what the large trend direction was. This one was just a couple of pips short, but that's absolutely fine. That was close enough. We then looked at our initial trade setup, and even though that that bar there went 3 tenth pips above the original setup high, we didn't get to our stop trigger. Therefore, you could have still left your entry trigger in at the same level, and that would have taken you into a short trade. The market came down, hit the first target, STF was strong, trail with our ATR stop, and the result would have been a nice 5.6R profit. The market is now reversed and carried on going back up again, but that doesn't matter because profit is taken, it's in the bank, and you say thank you very much. So hopefully this has been a good example of yet another way, or another example of using multi-time frame analysis, where we set up our DPs on our higher time frame charts. In this example, on the hourly chart on the British pound US dollar, we then went down to the shorter time frame, which was the 15-minute chart, and gauged our trade setups in the direction on that shorter time frame chart, and as a result had a nice profitable trade. So multi-time frame analysis on a forex chart. As a PS to this video, maybe you don't trade forex, but you still trade currencies, and you look at what we call the 6s, the 6A, 6B, 6C. These are basically the futures of the currencies. So let's have a look at the 6B, which would be the future of the British pound US dollar. So let's look at that. So we want to 6B, British pound US dollar future. Let's have the same. Let's go out to the 60-minute chart to start with. Let's do the hourly chart just as we did before. We'll be looking at the March contract 2016. Let's load this up. Just as we had before, here's the pound rallying up. We'd go back to this level here, put the DP on, and as you can see, we were basically a tick or so short. I think the low was at 48, and that high there was at 46. So a couple of pips, sorry, a couple of ticks, because we're on the futures now, short of that. So let's decide whether that's close enough or not. If you're more of an aggressive trader, you could probably say yes, that's close enough. Let's go down to the 15-minute chart. Now initially there's no setup up here, which is what we had on the forex chart, but of course remember we had a very low initial risk reward at our first target. So what I'm going to do here is, I don't recommend people do this unless they really know what they're doing, is I change in the risk reward ratio down to 1 rather than 2 for our setups, and can you see suddenly there's our TS1 setup arrive on the chart there. This is a little bit clearer because if I now place the analysis on, which on that red bar there would be the sell bar there, can you see that there's our risk reward of just about 2, so it must have been a decimal point or so, or just a fraction below that to not show initially, but there's our risk reward at our initial target. If I scroll in a bit, can you see how once we're entered there, the market got nowhere near the stop? And in fact, actually, if I just use our training mode very quickly to show you that there was no worry about having double tops with this, if I jump back to here, it's a lot clearer setup. There we go, go forward. There's our TS1 sell, place the analysis on. There's our entry level. Remember, we're going to our typical wave 3 WPT because it's the same as the previous chart. Market moved sideways. It would actually made a double top. That was a high of 36. That's actually 35, so it wasn't even a double top. It's actually below the TS1 high. Came forward. We're now short. Got nowhere near the stop trigger. So if I turn the training mode off, can you see how that actually would have been a slightly clearer and better setup than on our actual Forex chart itself? Just as we had before, STF is strong when we reach the first target, therefore you trail with the ATR stop. You'd be stopped out here, pretty much similar to the Forex chart at your ATR stop there, and the profit on the 6B here would have been approximately 8R. Remember, we use correct position sizing to keep our initial risk less than 2% on a sample $20,000 account. This would be shorting 9 contracts, turning initial risk of just under $400 into just over $3,200, so a nice profit of 8R. But can you see exactly the same as we looked at on the Forex chart, where we had our higher time frame resistance within a pip or so, sorry, a tick or so now because we're on the future of that 60-minute resistance, initial decline down, initial correction up, subdividing into an ABC. That's our holy grail TS1 sell. We're looking to go into the typical wave 3 WPT initially. STF is strong, we'll trail with our ATR stop, and we come out for a nice profit. So it's interesting that on this particular example, the future, which is our 6B on this, actually had a slightly clearer setup because there was no worry about whether you'd taken the previous high out or not, as we had in the actual Forex. That's the problem with Forex sometimes. Because of the spread, you can get slight anomalies like that going on. So sometimes trading the direct future is actually a slightly clearer chart than the base Forex. So hopefully that's been a good example for you Forex traders, and also you futures traders looking at a nice multi-time frame setup on the hourly and 15-minute chart of the British pound US dollar.